Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. After a midweek dip, the stock markets came back, but could the same be said for Bitcoin, lumber, and other commodities? Robert Campbell from realestatetiming.com checks in from San Diego. He gives us his thoughts on U.S. real estate, interest rates, inflation, and gold. He also has a health tip. WolfStreet.com's Wolf Richter reports from San Francisco on possible Fed tapering, consumer debt, the once-in-a-lifetime action in the auto market, and the future of electric vehicles. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk with Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show.
Good to be with you, Jim, and another one of those interesting weeks.
Yes, after seeing declines across the board midweek, did we have a decent bounce back?
Oh, in most items, not all items. Stock markets, yes, bounced back decently into Friday, although, volumes are really light. Here we are, we've just passed the best 6 months of the year, and now you get into what should normally be a bit more of a, tighter ranges, lower volumes, and hopefully it continues with the upside bias. The hard break we had into a week and a half ago, some good oversold readings, things like the S&P got down to their 50-day moving average, which is generally a good support area. And then midweek this week, we went back down to retest. And so far, it's been a successful retest. And if we were to go in the normal seasonal pattern here for the post-election year, we can allow for a little deeper break, maybe down to about 4,000 on the S&P, but overall trend is up into July unless proven otherwise. So, the market's selective; it goes through rotations. A week ago, we put out a report on the green economy, the stocks that have a green end to them, but in reality, so many of them take a lot of mineral resources and other things to get in place. But, we've had January highs in pretty much everything in that sector, whether it be from solar to, alternative fuels, that type of thing. Big upside exhaustions right into the inauguration, and then everybody just fell flat on their faces. We ended up with a lot of the stocks down a good 40 to 60% off their high, at which point we got some great capitulation lows. So things like Ballard Power, Brookfield properties, these things are up 15 to 20% just in the last week and a half because they got so overdone. And they look as though they've probably got a little bit more left in them in terms of legs. So, there are going to be opportunities at any given time.
Now, lumber has been a darling of the commodity market, but is it still?
It's not for the faint of heart. Here we were, a week ago we were talking about lumber having just kissed $1,700, an all-time high by an absolute long shot. Reversed, and this is where we got upside exhaustion readings on our daily, weekly, and monthly charts. So lumber prices promptly turned the corner. we ended up with a series of limit down days all the way down to $1,200. So, dropping $500 is just, unheard of. And then we turned on a dime on Wednesday, just as the stock market also turned, and ended up with 3 limit days on the upside. So it's one of those markets where volatility is now reigning. Whether it's capable of a whole new high or not, the fact is that we are into a mode that I think only people who need to be buying or selling the product should be in that market. Now, it's interesting. Other commodities ended up with big action here, too. I mean, the corn market, we had upside exhaustion in that. We had it in soybeans. We had it in copper. And all of these have come off significantly from their highs. Normally, when you have a run like this, we look for prices to drop initially to the 20-week moving average. And once we got those signals, then if one was to buy puts on any of those, corn options are up 100% since then. Soybeans are up 40%. The copper puts are up 40% in the last week and a half. So, as things become excessive, there are great ways to take advantage of them, just like there was the capitulation on the bottom for the ESGs and the bounce that they're having.
The Bitcoin chart the past week looks like a profile of the Rockies.
Yeah, well, it's pretty jagged out there, isn't it? We got here's another one of those ones where extremes were created. In a span of 48 hours, we went from 45,000 down to 30,000, and then back to 42,000. So, this is what happens when you've got a junior market, I will call that, where you've got a lot of enthusiasm, and then you get people such as Elon, and as well as the Chinese government, coming out with a few negative comments, and the bottom just drops out of everything for a while. Looks like, now we've seen this type of capitulation and sell-off, it's got to be the 4th time now on Bitcoin since 2016 or 2015. And generally what has happened is you get that hard sell-off, a bounce, and then you come back down, and it takes a while to build a base here. So we're probably going to have to do a retest of at least maybe the 32,500 level, do a little bit of thrashing around here before it has a chance to do anything more on the upside. So, the easy money on Bitcoin was from October through until January. It's been pretty rough since then, and I think it's going to see a lot more of this volatility before things settle down.
What's going on with gold?
I like the way the gold market's moving. It has been a steady move up to 1880 this week. Has had a few overnight shakeouts, nothing of big magnitude, $10 or $15 here or there. And it's now retraced half of the whole drop from last August. Looking for it actually to retrace maybe more like a 60% move, so that'll put you into the 1920, 1925 level for, I think, a pretty decent resistance level. And some of the miners, if we look at the GDX or the GDXJs, the ETFs, they're looking a little heady right now. They've had pretty good runs off the bottom, and I wouldn't want to trade that last maybe $30 or $40 move on gold on the upside is with the miners. I think they're going to be in need of a bit of a pause.
What about the U.S. dollar?
U.S. dollar, a bit of a bounce midweek, but couldn't hold on to it at the end of the week. And, we're right back down to where we were in January, actually more like the end of December. So we had our classic seasonal rally in there. We're into a period of weakness right now. And, if anything, you look at, the Canadian dollar, which is up here just teasing the 83-cent mark. And surprisingly, it's managed to hold in through the whole week, even though you've had the rollover as far as the base metals were concerned. Copper's dropped from just shy of 490 and then down to the end of the week at 450. The grain prices, as I mentioned, those have rolled over. Lumber's looks like it's putting some kind of a top and going to thrash around. So it's really surprising that we've got this 83-cent dollar holding in here. And as I see this, it's a long-term base from about 2016 through until just the tail end of last year. Nice breakout, but this type of pattern should end up with a pretty decent correction. And I would think something under 80 cents is probably in the offing in the second half of this year.
Ross, thank you so much for being on the show.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Robert Campbell next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter, online at realestatetiming.com. He's speaking to us from beautiful San Diego. Bob, welcome back to This Week in Money.
Thank you very much for having me again, Jim. It's always fun.
Before we get into the report here, can you tell us just a bit about the Campbell Real Estate Timing Letter?
Absolutely. I'd be happy to. Back in 2002, I wrote a book called Timing the Real Estate Market, and that can be found on my website, realestatetiming.com. And I presented a formula, everything you need to know, no secrets withheld, a formula for timing real estate markets that are based on only following 5 key indicators. And that soon led to people read the book and they go, well, what's going on in this city, that city? So almost immediately I started writing the Campbell Real Estate Timing Letter that followed then 17 cities first off, and now I follow. Let's see, 17 and 6. That's 23 cities, 6 of which are in California. So all over the country. And so I've been writing the Campbell Real Estate Timing Letter for 19 straight years. So I'm getting pretty good at it after 19 years, Jim.
The Dow hit 35,000 points. Could the stock markets continue to rise?
Yes, it can. Absolutely. Especially now when you're seeing some things happening, the potential for war and other kind of things that I think the upper limit on the Dow for somebody I follow, and that's sometimes a guest of yours, Martin Armstrong, he said 5 years ago that the Dow could go to 40,000, and everybody thought he was crazy. We aren't that far away, are we?
Yeah, well, Martin's been right about a lot of things that they laughed at him about.
Exactly true. That's why he brought up his name, my friend. Performance speaks louder than words, right?
Well, Marty does that. So what's going on with the U.S. housing market, and is it different state to state?
Well, it varies a little bit. Let's just look at things nationally, and then within the state of California. It varies a little bit state by state, but not much. Every state in the United States is on afterburners right now. That's how fast prices are accelerating ahead. And interestingly, the 2 top states that are accelerating the fastest have been in the number 1 or number 2 or number 3 position for almost the last 5 years. They're Idaho and Montana. Everybody's leaving California and Portland and Seattle, and they're moving to Idaho. They're trying to get away from the craziness.
So, when you describe craziness, what do you mean by that?
The political scene. Not everybody subscribes to socialism, and defunding all the cops, and violence and that kind of thing. A lot of people are old school. They said they believe in law and order and the Constitution, and they want to be in a safe place around sane people. And they're hard to find here in California, Oregon, especially on the coast, Jim. Especially on the coast. It's that you go, like for example, that Oregon right now, the eastern half of Oregon and the eastern half of Washington are trying to secede and join Idaho. And if you go in California, what's going on the coast, in the urban cities along the coast, is completely different than what happens in the Central Valley, where all the conservative farmers and those people are. So, you get off the coast, the three eastern parts of the state could form a state of their own. And they're trying to do it. I mean, this isn't just a wet dream anymore. They're trying to pull this thing off. A lot of people are sick of what's going on.
Could the states opening up have an effect on the real estate market as well?
Oh, absolutely. I mean, interestingly, though, they say everybody's leaving California. I mean, that's kind of a unspoken assumption. Everybody's leaving California. Interestingly, the three major cities in California, San Diego, Los Angeles, and San Francisco, are some of the fastest. Their price appreciation has been some of the greatest in the United States in the last 12 months. So obviously, trust what you see, not what you hear.
Would hyperinflation be bullish or bearish for the real estate market?
That's an excellent question, and the answer is very bearish. And the foremost reason is this: real estate prices is credit driven. It's very, very subject to the availability of credit and the interest rates that's charged. When you get into hyperinflation, Jim, not only are interest rates go from 3% to 30% or something, but also nobody's willing to make the loan because inflation is raging so fast. Nobody's going to give you a 30-year loan if inflation's 100% a year. So you know what it turns into? It turns into a cash market, which tends to screw people up. How many people can come to San Diego and pay $700,000 cash for the average price home?
Well, maybe if they sold their house in Vancouver.
Exactly. Or Toronto.
Yeah.
Those are two good exceptions. Other than that, there's not many others.
But then we have to convert our $1 million Canadian into U.S., and that would be $750,000.
Excellent point.
Yeah. With all the inflation money printing, could we see a surprise spike in interest rates?
Absolutely. Absolutely. We don't know where this is going to start. I was in real estate. That for everybody's listening in, I may sound like I'm a young kid, but I'm not. I'm 74 years old. I was around during the 70s. I was in the real estate business in the 70s. I've been around it my whole life. And mortgage rates in the United States, for those of you that are old enough to remember, went to 17%. You know what that would do to this market? It would crush it. Housing prices would fall 50%. And you know why they went to 17%? Because inflation went to 13%. Who knows how? I mean, the U.S. government, the CPI, the government reports that CPI is 4%, 4.2%. That's complete BS. Everybody knows it's totally understated. And if you look at things realistically, like what things have inflated, I'd say in the real world, the inflation rate, is for things people need. I mean, if you don't look at TV sets that seem to get cheaper every year, things are inflating right now, in the 7 to 8 to maybe even 10% range.
Well, don't forget the CPI cost of living index is officially fudged by both the Canadian and U.S. governments, which back in the 90s agreed to drop housing and fuel, and apparently taxes as well as a cost of living. So if you take fuel, housing, and your taxes out of the equation, it's pretty affordable to live. But in the real world, you have to pay for a house, you have to get around, you have to heat the house, cool the house, wash clothes, wash dishes. They all take energy, but that's been thrown out of the equation. And your taxes aren't counted.
The price of beef has gone up, like let's say, for example, 300%. But they only show the price of food going up by 100%. You know why? You can eat cat food and survive, right? That's called a hedonic adjustment.
Well, yeah, they used to be the cost of beef used to be the cost of steak, and now it's the cheapest piece of ground whatever, mystery meat.
And the same thing with cars, Jim. I mean, if you look at what they do with these hedonic adjustments to cars, that the price of a new car, after they make all these downward adjustments, has barely gone up much at all in the last 20 years. Because the new cars are better. So what you're buying isn't apples and apples with the old, right? Just the fact that it costs 3 times as much, once they make adjustments, they go, oh, and after all the new features it has, really you're not paying any more at all.
Well, yeah, I'd like to be able to, I was going to say, why can't I buy a basic car? I don't need a rolling computer, information, entertainment, television, movie watching system. I want a car that gets me from point A to B.
You don't need a heated front seat for the driver?
No, and I don't need a heated steering wheel either. I can wear gloves.
I don't think people can survive nowadays, Jim, without those two things.
Yeah, like I said, the new Cadillac SUV, the entire dashboard is a video screen. Now, is that going to be distracting for the driver or not?
Would be for me. I'm looking at a video screen too much.
Yeah,
like everybody else is nowadays. Right?
I find the radio too much of a distraction. That's why the most expensive high-end sports cars don't have a sound system. Too distracting. If you're doing 260 miles an hour, you shouldn't be playing with the radio.
Right.
So going forward, do you see inflation, deflation, or stagflation?
Well, it's definitely not going to be deflation. And I say that because history is a great teacher. And if you go back 50 years in the history of the world and you look at all the, let's just use hyperinflation versus deflation, I think there's been 100 times more hyperinflations than deflations. And the reason that's the case is the central banks all have printing presses and they won't allow that to happen, Jim. Like Venezuela, Argentina, Czechoslovakia, Zimbabwe. They will never let things deflate because it'll destroy the whole bond market, and the bond market's 5 times bigger than the stock market in any given country. And if the whole bond market just goes up in vapor, that's the end of the economy. Everybody would be dirt poor, and especially the fact, do you know who owns bonds, Jim? Do you think poor people or rich people own bonds?
I have a feeling very rich people.
Yeah, so they have a vested interest in not allowing that to happen.
How are housing production costs affecting the pricing of homes?
I'm so glad you mentioned that because the cost of lumber has gone up like 350% in the last year. And I was talking with somebody yesterday, and they say lumber futures, however, have dropped for 8 consecutive sessions. I didn't look at them today, 8 consecutive sessions, and knowing markets the way I do, after something goes vertical and then all of a sudden falls out of the sky in 8 consecutive sessions, you know what that's a sign of? It's over. So I wouldn't be surprised to see lumber come back down, to near normal somewhere. But the high cost of lumber by itself has added $35,000 to the cost of a new house. And not saying everything else that goes into a new house. Has anything that you need that you put in a house, furniture, food, carpeting, has any of that gone down in the last year? No, of course not. So I'm saying the price of a new house has probably gone up by $50,000, and people have just been priced out. And that's reflected in one of my 5 key indicators that I use to time real estate markets, Jim, is new home building permits. Last month, I think it was April, new home building permits fell by 9.8% in the United States. So the builders are clearly beginning to feel it. They go, you know what? We're not going to. Let's say the median price home 3 months ago or 4 months ago was $380,000. Now it's $50,000 more, $430,000. Is there a market for that home? No, I don't think so. I better not pull as many permits because I'm going to be stuck with these things.
Well, I'm always nervous when the government says we're going to step in and correct things. I know in BC, the former BC Liberal government said we're going to make homes more affordable by giving you a $37,000 low-interest loan. Well, all that did was boost the prices by $37,000.
Oh yeah, I mean, and exactly that. You know what? That a year or so ago, I heard something really funny, and they said, "You think college education is expensive now? Wait until it's free from the government." Milton Friedman, very, very smart economist, well respected. He said, "If you put the U.S. government in charge of the Sahara Desert, we'd be out of sand in 5 years." After studying economics for 50 years and having a degree in it from UCLA, I've come to the conclusion that there are only 3 economic principles that have any value, and everything else is theory, opinion, or pure BS. And one of those principles is there's no free lunch. Does that ring a bell?
Is there a correlation between home prices and interest rates?
Actually, the truest answer is no. That sometimes real estate prices go up when interest rates fall, but when you get into downturn, the last two real estate downturns we've had here in the United States, and especially in California. And I refer to California, you guys, because, more so than anything, not only because that's where I live and that's the biggest interest in real estate. California has the biggest booms and the biggest busts of any state in the country by far. And during the last bust, during the 1990s, when real estate went down for 6 straight years, interest rates fell 3 percentage points during those 3 years, Jim. During the 2006 through 2012 bust, interest rates fell 5 percentage points. Did that stop the decline? Maybe it slowed it down a little, but did it stop it and reverse it? Nope.
What are your thoughts on the U.S. dollar?
I think the U.S. dollar is in trouble. I mean, who doesn't? The Fed's printing money like there's no tomorrow. I mean, that, and inflation gets, here's what happened in the 1970s, where the U.S. dollar lost half of its value, against other currencies. The inflationary 70s, because of the Vietnam War. The American taxpayer didn't pay a dime for the Vietnam War, because they couldn't afford it. It was all financed with debt and cash. And so all of a sudden inflation took off, kind of like it's starting to take off right now, and it went all the way up to 13.3%. And interest rates, and what the Fed chairman, Paul Volcker, had to do to save the dollar. The dollar was on the verge of collapsing. He had to crank interest rates up. They put the prime rate at 22%. I think the Fed funds rate went to 22%. Mortgage rates went to 18%. They had to do that to save the dollar, because and that's how you save the dollar, because once all of a sudden you can buy a dollar and get an 18% return on it, on just the dollar, that's not bad. People are willing to step in and buy it. But if inflation's going off at 13.3 and you make 3% on a treasury bond, nobody's going to buy it. And the dollar collapses.
Due to COVID, people have been receiving stimulus checks from the U.S. government, and people have been allowed not to pay debts. Can the free money, ignore your debt scenario continue?
No, it can't. I mean, you look past. I mean, the U.S. economy isn't in that. If you look at retail spending today versus pre-COVID, it's higher today than it was. I mean, by a significant margin than it was a year, 15 months ago. And you go, why? Because people have more money, especially the people that got unemployed. Today being unemployed, if you run things right, you get your extra $300 a month times 4, that's $1,200. Plus unemployment, whatever that is. A lot of these guys are making $2,500 a month by not working. You can survive on $2,500 a month by not working if you're a kid that lives at home. And so what are they spending their money on? I guess, I don't know, but they're spending money. Mm-hmm. And all these kind of things that they're doing. They have more money that they know what to do with. But can that, and another reason why they have so much money and spending's increased, you don't have to make a student loan payment if you've been negatively influenced by COVID, and who hasn't, right? You don't have to make a car payment. You don't have to pay your rent. You don't have to pay on your credit cards. So it's all upside, no downside. How long can that go on before the whole system collapses?
Now, I had a report here from one of our correspondents this week that said U.S. credit card debt has actually fallen a substantial amount because people are using that stimulus check to pay down debt. They're not wildly spending it. What kind of an effect is that going to have on the U.S. economy?
Well, well, it's certainly having an effect on the bank. Actually, it's going to have a positive effect. The less people are in debt, the more borrowing power they have going forward, to buy things. But the thing is, they're using all this money that they don't need, free money, a lot of it to pay down debt, and then, especially when they don't even have to make payments on it, Jim. Why not? Why not take, let's say your typical, I don't even know, I'm not a credit card guy. Let's say the typical, minimum payment on a credit card today is what, $250? You don't have to make that payment, but all of a sudden, now you have $250 in your wallet and more, because you have to make, take that $250 and just pay down the debt. I mean, that's a smart thing to do. I mean, what happens after this thing? In my last May timing letter, I said, how's this all going to roll out? And I said, nobody knows. How many of these people that are in forbearance plans, 2.7 million homeowners in forbearance plans, when these forbearance plan ends, how many of them are going to be able to take over the payment and pay? And he said, oh, well, we don't know. Okay, how many of them will be able to be forced to put their properties on the market? It won't go into foreclosure because they've appreciated so much in the last year, but still they're on the market. You could have 2 million properties hit the market in a very short period of time, which would triple the inventory. I mean, and relative to stable or falling demand, it's all about supply and demand. I mean, now you could have the whole real estate market reverse course, and prices start falling as opposed to rising. So all these things, and I mean, these credit card things, and you look in the city of San Francisco, for example. I just read today where Airbnb, they went public in 2020. I think their stock went from like 50 to 100, for example, and now that they leased all this space ahead of time in anticipation of there being a shortage, which there isn't, and now the stock's back down to 50. So, I mean, there's a lot of vacancies. And what are these people with these buildings going to do where they have no tenants? They're probably going to get bailed out by the Fed. I think everybody's going to get bailed out by the Fed. I think they're just going to open up the spigots. Anybody that had anything negative, any negative outcome that was due to COVID, or they think it was due to COVID, the Fed's going to step in and make them whole. What's that going to do to the dollar? What's that going to do to inflation? Nobody loses anymore, Jim. Pure socialism. Nobody loses. We don't know. We're just guessing how all this stuff is going to, I mean, how many of these people, how many of these businesses that aren't paying rent are going to be able to start paying rent again? We don't know. I mean, you can't tell in advance. You're just guessing. So we're just going to have to watch the numbers real close, key numbers that are reflective of how this is being manifested in the supply and demand figures to whether real estate's going up or down, which is, what my key indicators do, and monitor it and adjust accordingly. Anybody that tells you they know what's going to happen 2 years from now is lying to you.
Is one of the reasons why house prices have gone up so much is because there was a moratorium on foreclosures, so you couldn't pick up a cheap foreclosed property from the bank anymore?
Absolutely. That certainly contributed to it. Whether it was how big a factor remains to be seen. But and I'm glad you asked that question, because 2 out of the 5 key indicators that I follow are mortgage defaults and foreclosures. With the moratorium, guess what those have fallen to in the United States? Near zero. Historic lows, because you can't foreclose, and you can't put a house into foreclosure, ahead of time, because it violates the COVID rules. So no, it's a totally artificial market, Jim. And that just goes to show you, when that all ends, when all of a sudden people say, you know what, I'm gonna file a mortgage default on you because you haven't paid your mortgage in 8 months, and I can do it legally. I mean, how many of those are going to happen? You don't know.
Gold looks like it might be waking up. What do you see ahead for gold?
Oh, I think it's going to roar, Jim. I've been telling my followers for at least 3 years now, take a position in gold. It's net. It's going to be the best performing asset, in the coming years, and everything points to higher gold. Everything points to, that the cycles point to higher gold. Just the fact that we're printing money is, higher gold. And who do you trust? Who do you trust, the U.S. dollar or gold? How about gold? Especially now that the currency has been, debased, is being debased the way it is. So I think you're going to see a rush to gold. And one interesting thing about gold is that it's a very small market, Jim. There's not a lot of gold in the world. And all of a sudden you see people with a lot of money go, yeah, I think I need to double my position in gold. It doesn't take much increased demand to see gold, that shoot up in price dramatically. So, and I'm also for commodities. I think commodities are going to do extremely well. Commodities are cheap relative to everything else. And, everything in life is, works in cycles. Everything has its day in the sun and its day, its day out of the sun. And commodities are super cheap relative to the stocks, bonds, and real estate, for example. And so I think, just as the contrarian and looking back at the cycles, I think commodities is an excellent bet. If I had to invest new money right now, would it be in stocks? No. Would it be in real estate? No. Would it be in gold? Yes. Would it be in commodities? Yes. And I certainly wouldn't buy bonds.
Back in the 30s, the U.S. government confiscated gold. They could decide to confiscate your gold again. Is this bullish for silver?
That's an interesting question, and I've read a lot about that, of course, because I'm an economist, and I heard, you can't trust what history books tell you, Jim. History books tell you the government came in and everybody willfully turned over the gold. I've read it from inside sources that went through that period and say that was pure BS. People didn't give them the gold. And that was back in the 30s when people tended to trust the government. Do you think they trust the government to the same degree today that they did 90 years ago? I don't think they'd give you anything. I don't think they'd let you in the door. They can confiscate your guns, your gold when they come for your guns.
What if you have a golden gun?
That should be an interesting experience, Jim.
It's just a piece of jewelry, honest. People are getting injections that are being promoted by a known eugenicist whose goal is depopulation. If there was a major depopulation event, what would that mean for real estate?
It would go way down, Jim. The supply isn't going away as fast as the population would go down. I mean, houses last 50 years. If all of a sudden we lost a significant, portion of the population, 10%, 20%, who knows what the number is. All of a sudden there'd be a lot of houses and less people to live in them. The price of real estate would crash.
Well, the middle class was invented during the Black Plague in London, because all the skilled workers died. In some places, the death rate was 90%. So all of a sudden, if you wanted somebody to build your castle or your mansion, you actually had to pay that person decent money. That's where the Masons came from, was after the Black Death in London.
Oh, that's interesting. I'd never heard that before. But yeah, I mean, people tend to overthink things. Don't overthink things. Think in terms of supply and demand, which rules price movement. All of a sudden, you have, let's say there's 10 million people in the United States and they all own a house. And there's 10 million people in the United States and they all own a house, so that means there's 10 million houses. All of a sudden there's 7 million people in the United States with 10 million houses. What's going to happen to the price of a house? It's going to go down. Oversupply of houses relative to people. I learned that, Jim. I mean, I just turned 74 years old, and one of the biggest mistakes people can make is to overthink things. Just stand back and just look and use your brain, but don't well, this could happen, this could happen. Yeah, and a meteor could hit the earth, too. You got that factored into your decision-making?
Are market trends important to a disciplined trader?
They're absolutely essential, because the reason that most people don't do well in the markets is for one big reason, human nature. And human nature is driven by fear and greed. And like right now you're seeing a market that's just roaring ahead, and people are overbidding to get into the housing market, fear of missing out, or whatever else the reason may be, and there's just jumping aboard, the moving train as fast as they can, overbids. I heard of a house somewhere that was put on the market for $400,000. It had like 200 overbids and sold for $700,000. You think that's a good buying time to buy? No, it's not a good. I mean, if you study history, you go, that's the worst time to buy. You want to buy when there's things just laying on the ground, then nobody wants it. My favorite real estate strategy, guys, is to buy low and add value. In other words, wait for the correction to come, buy an excellent piece of real estate that's had nothing done to it in 30 years, so there's a lot of upside for you to use your brain and creative building skills to add value and hold on to that house for 5 years while it appreciates, and for every dollar you put into it, you've created $2 worth of value. There's no easier and safer and more profitable way to invest in real estate.
What do disciplined traders focus on when they're looking at buying or selling a financial instrument?
They look at those two factors, fear and greed. Fear and greed, because I trade stocks. I've been trading stocks since I was in high school, which was, over 50 years ago, and I've done everything, make every mistake in the world without losing my ass, because, I don't like losing money, but still you got to learn through experience. And about 5 years ago, I learned a system that I use that consistently makes me money, with very low drawdowns. And what I'm fighting all the time, and I'm really good at this though, Jim, I buy things that are in uptrends where there's a sell-off. Like I bought the S&P 500 2 days ago after it fell 500 or 600 points, and I held it for 3 hours and made 1% on my money and sold it. Hey, if you can make 1% on your money consistently over the course of time, that's a great return. I've never had a losing month, but I'm not going to sit there. Once I've made my 1%, I'm not going to say, gee, I think this thing's going to the moon in the next couple of days, and I could make 2 or 3 or 4% or even more. Nope. I take my 1% and I just wait for the next buying opportunity. So I buy into fear, and then I sell as soon as I've made my, a fair profit, and all I want is 1% a month on my money, 12% a year, with very, very low equity drawdowns. My equity drawdowns, I don't think I haven't had a losing month, and I don't think I've lost a total equity drawdown on my account. I don't think it's ever exceeded 2%, which is almost near zero. Most of these guys that make these big returns, that more than 12%, most people don't even average 12% for one thing, but that claim to make these returns, they can have equity drawdowns of 20, 30, 40, 50%. And, most people, people are uncomfortable with losing that kind of money. Jim, it's been proven statistically that the thrill of making $1 in the market, the agony of losing $1 in the market is twice as great as the thrill of making one. People can't stand the downside. That's why people panic. They lose money and they panic. And they buy at the wrong time based on greed, and then all of a sudden the market goes the other way and they panic and they sell at the wrong time. That's just human nature. Only like that. I've read between 5 and 10% of all traders doing what I do make money. And I'm very proud to say, even boast about the fact I'm in that 5 or 10%, because it's hard to do. It's rare. But it's based on a system I use that took me 45 years to develop. It's just say that, and it works and works and works and works. For me. I could make a very good living, just turning everything into cash and trading my account all day, and I'd make 12% on my money. If I had $1 million, I'd make $120,000 a year. I can live on $120,000 a year. I don't need more than that. I have a simple life, that everything's paid for. I have other sources of income and that kind of thing. But you know why I wouldn't do that, Jim? I'm not going to sit in front of a computer screen 6 hours a day and trade. I won't do it. I wouldn't do that for $10 million a year. I'm too old for that. Yeah, I just don't want to do that. But could I? Yeah, I could do that.
Are there stumbling blocks for disciplined traders?
It all goes, I hate to be so repetitive, but it's all fear and greed. Until you can control fear and greed, you will never, ever be a successful investor. Ever. You just can't. That's the whole game. Is, like Warren Buffett says, the saying he's most famous for is, they asked him, how do you become a successful investor? He goes, close the door, buy when everybody's fearful, and sell when everybody's greedy. And he's absolutely 100% right. Is that easy to do? No. It can take a long time. It's taken me, almost a lifetime to figure that out and to put it into practice. But that's the formula, my friend. That's it. There it is in a nutshell.
I think you might have mentioned it, but what percentage of people make money in the markets?
Well, as a trader, 5 or 10%. 5 or 10%. And that's a true statement, and I've read that. That's not just a number pulled out of thin air. because I've read statements from brokerage houses, the big, the old Merrill Lynch's. I don't even know if those companies exist, J.P. Morgan and, Morgan Stanley and all that. And they report, there's people that trade, and they go, what percent of your traders make money? Very low. You could even go to someplace like Vanguard. I mean, that's the biggest brokerage house in the world. I'm sure they have exact figures on people that run trading accounts. And at the end of the year, they compare their balance at the start of the year with the end of the year. 90% of them are down, at least.
What's your thought on this? What you know versus who you know?
Well, that depends. If you're in politics and on Wall Street, it's all who you know. If you're out in the real world like the rest of us, banging out a living, survival of the fittest, it's what you know. You think all these newfound billionaires aren't connected? Of course they're connected. You think all these guys are like 1,000 times smarter than the average guy, 50 years before them? No, they're just connected. They know who to pay money to get special privileges and to get bailed out when their stupidity, shows and they lose all their money, especially if you're in the banking or Wall Street business.
Well, I certainly like watching that show Below Deck about the super yachts and the crews below them, but I pay attention to the guests, and you can always tell who've come from family money and didn't have to earn it themselves because they're the rudest people. The ones who earned it still appreciate the people who work for a living.
My dad used to build homes for 55 years in a very exclusive area here in Southern California called Rancho Santa Fe. I don't know if you've ever heard of it, but he always made the comment to me. He said, Bob, you can tell who old money from new money. You know how? New money is always talking about it.
Are some areas of the U.S. healthier to live in than others?
I think so. I think any place that's near a coast, for example, is healthier because they have more humidity in the air and your skin is less likely to dry up like it does for people that live in Las Vegas and Phoenix. I'm into anti-aging, not accelerated aging. And you go to these dry areas, you go to Phoenix, and somebody that's 55, that's lived in Phoenix their whole life, and they're 55 years old, they look like they're 65. You go to some place like Hawaii, where it's real humid, somebody that's 65, they look 55 or 45. It's because it's the condition of their skin, Jim. They just look younger. And of course, you don't want to live near a toxic waste dump anywhere.
Of course not. What do you have for us on the health front?
Well, what on the health front that, I'm sure many of your listeners that have heard me speak about so many things before, I'm right in the middle of a thing that, right now where I'm trying to lose 6 pounds of body fat, and it's going to take me, a total of 6 weeks to lose it. I know that's real rapid weight loss, but, that's, once you get to be my age, 74, it takes longer than you think. And I mentioned last time, and I can't emphasize it enough, I want to re-emphasize the point, if you guys out there that want to avoid getting colds. I used to get 1 to 2 colds a year. I started taking 50 milligrams of zinc every day. I haven't had a cold since. Zinc is a miracle supplement, guys. And how I found out about it, discovered it, and how well it worked, is when I used to take plane flights, to travel to cities to give speeches to, 50% of the time I'd get sick from being on a plane with sick people. So you take these things like Airborne and other things like that they advertise on TV, and like for 10 tablets, they cost like $20 or something like that. So they're not cheap. And so finally I looked at the ingredients one day, and I said, what keeps you from getting sick and getting colds? And 80% of Airborne was zinc. So I said, I looked at this thing that cost $20, and I went on and said, let me go check out what zinc tablets are. 50 milligram zinc tablets. 100 tablets you could buy for $5. So guess what I take now?
The British Cold Institute, which was trying to find a cure for the common cold, found 2 things worked to stop the cold, a combination of vitamin C and zinc.
Yep.
You can get vitamin C zinc lozenges at your local supermarket.
For nothing, right?
So, yeah, and if you feel a cold coming on, just suck on one of those. It may not cure it, but it'll slow it down or make it less severe. That's been my personal experience with it.
I just haven't had a cold, Jim.
Well, you're lucky. I catch everything.
Well, I don't. Thank God. But and the only thing I can attribute it to, because you say, okay, I used to get 1 to 2 colds every year that really sucked for my whole life. And 5 years ago, I started taking zinc tablets, and I haven't had 1 cold. So it's the same old scientific study. What changed? Was there anything? What changed during the last 5 years? Only one thing. I started taking zinc. I mean, will that make the scientific journals? I mean, with me as a sample size of 1? No. But what you just reported to me, that's already been a proven, a proven cure for getting colds. And it works, guys. It works.
How can people find out more about your book and newsletter?
They can go to my website, realestatetiming.com, realestatetiming.com, and they can buy my book, which is $35, or they can subscribe to my timing letter, which is $135 a year. And if you subscribe for 1 year, I'll give you a free book, with your first year subscription. But I want to let everybody know. In fact, you guys are the first guys that I haven't even announced it to my followers yet. Because of inflation, I'm raising the price a whopping $10 a year for my timing letter, and I'm going to raise the price of my book $5. Things have gone up. Everything's gone up. I haven't raised the price of my book in 15 years. This is getting ridiculous. How expensive things are getting. I mean, stamps, paper, copying, gasoline, go right down the line. I mean, so I'm going to raise it by $10, which is less than 10%. So, I mean, I'm gonna, give a heads up to all my followers, so it's not a surprise to any of them. So anybody that's on the fence right now, they can get the old price, but it's really true. So first time in almost 20 years I've raised my price. I'm gonna raise it a whopping $10.
Bob, thank you so much for being on This Week in Money.
Thank you, Jim. We'll talk again soon, okay?
You got it.
Bye.
My guest has been Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter, online at realestatetiming.com. He was speaking to us from San Diego. We now go to San Francisco, where we'll be talking to Wolf Richter when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Wolf Richter, publisher of WolfStreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money.
Thanks for having me back, Jim.
Up till now, the stock market has seemed to be bulletproof. Is there anything that could take it down right now?
Well, it's certainly perched up there, incredibly overvalued and inflated by massive central bank stimulus and not just in the U.S. but globally. So it's really ready to come down. And we can see that every day there are certain parts of the stock market that are already getting crushed. Some of the biggest high flyers have gotten knocked down by very large percentage margins. So in general, I think what we're kind of seeing now, there's some unraveling going on beneath the surface in a lot of these former high flying sectors. But in general, I think what I would worry about in terms of the stock market, and there's several things, and one is higher long-term interest rates, and we've been getting those. So they've been rising since last year, and the spreads between the Treasury securities and corporate bonds is still very, very narrow, and so I would expect those spreads to widen eventually. So that would make corporate borrowing a lot more expensive, especially for high risk companies. So that would be something to look at. Then the big thing, of course, is the reduction of central bank support. The Bank of Canada and the Bank of England have already come out with their plans to reduce the asset purchases. So by year end, the Bank of England will have ceased buying assets altogether. The Bank of Canada has wound down its liquidity support, and its balance sheet has been dropping. It's now announced a reduction of its Bank of Canada bonds. And a reduction in the purchases of tapering of its Bank of Canada bonds. And so these are the first steps that central banks are doing. Now everybody is looking at the Fed. Now the minutes came out today of the last meeting from the Fed, and in these minutes they announced that they're now talking about tapering. And so tapering the asset purchase is on the table now. And they will, meeting by meeting, they will get closer to this. So this first announcement, so this is the last meeting, this was a few weeks ago, they are talking about tapering, and then at the next meeting they're going to actually be talking about tapering, and then after that they're going to announce the tapering, and they will start it this year. That's what it looks like. Central banks will end the asset purchases before they will raise interest rates. So that's the first step, is to end the asset purchases, and that's what's going on now. So this is being planned. This is on schedule now, and it's happening. Interest rate hikes will come after that. Then the next thing that will pressure markets is inflation, and a lot of people say inflation is good. But it's not good if it gets past a certain point. And at that point, it becomes an increased expense for companies. And they've already complained about this. Raw materials, components, parts, everything is getting more expensive. Now there are pressures on the labor side, and companies are having to raise their wages. And so that, for many companies, is the biggest part of their expenses. So now they're looking at higher costs, and they're having to raise prices and to make up for that. And that's lagging behind. A lot of companies have raised prices somewhat, but less rapidly than their costs have gone up, so their margins are shrinking. And that's not good for stocks. And some of that has come out. Then we're looking at record indebtedness of corporate America. And so during the pandemic, as the interest rates were repressed and loans were really cheap and bonds were really cheap to issue, corporate America has issued an enormous amount of new debt. And when interest rates rise, some of these interest rates are locked in and some of them are not, but when interest rates are rising, you need to replace over time, some of that really cheap debt with more expensive debt. And so there will be pressure put on these companies, and some of them may not be able to borrow at the higher risk level. They may not be able to borrow anymore. And so you see a surge of bankruptcies. And the European Central Bank just today came out with a warning, expecting much higher levels of bankruptcies as central bank support subsides, and that will be true in every country. We've had, during the pandemic, we've had a plunge in bankruptcies. The bankruptcies have essentially ended, and because it's so easy to get money, and that era is now coming to a close. So it will be tougher for companies that have problems to borrow, and that will eventually show up in the stock market. And then a biggie is the leverage. And there's enormous amount of leverage in the stock market, and it takes many forms. And the Fed, in its financial stability report last week, just warned about the leverage, and especially the hidden leverage. So there's a lot of leverage that we can't see that is not being reported. When the family officer, that's a privately held hedge fund, Archegos, blew up a month ago, it was because of hidden leverage. Nobody really knew how much exposure they had. They were borrowing from different banks. None of the banks knew. So for their holdings, for the equity holdings, and none of the brokers knew how much they had actually borrowed, because we're doing it from different brokers. And so the Fed actually included that particular episode in its stability report, and warned about it, and saying, look, there is other stuff like this. This hidden leverage is massive. It's out there. It's large. And we don't know what it is, and it poses a risk. We do know that overall leverage is very high because we see the reported part. There is margin debt, which is reported every month, and it has just spiked incredibly. It's up 60% from just before the pandemic. it's reached $850 billion in the United States, and that's only the tip of the iceberg. That's the part that's disclosed. That's the part that we know about, and but it indicates the trend. So there is a huge amount of leverage. People have taken, and companies and hedge funds have taken enormous risks with enormous leverage, and that has driven up stock prices. So when you borrow money to buy stocks, that is that drives up the stock valuation if it happens on a large scale. At the same time, when the leverage unwinds, there's selling going on, in part forced selling, and that drives down stock prices. So now we have this enormous amount of leverage that is just waiting to unwind. And when that happens, the regular sell-off will become much harsher and much more painful. So that leverage there, it won't trigger itself a sell-off, but when we do have a sell-off, that leverage will kick in and reverse and will make that sell-off much, much worse. So, I think we're looking at a scenario where there's a lot of reasons for the stock market to go down, and then when it does go down, and it's sort of started that already, when it does go down and the leverage gets unwound, then this will become a much more dramatic sell-off than it would otherwise be.
There's been a lot of commotion about consumers in the U.S. paying down their credit card debt. What's going on there?
It's amazing. The American consumers are known for their the heroic ability to borrow money, even when they can't afford it. And so in terms of credit card debts, they have paid down the credit card balances by 17% since the peak in the fourth quarter of 2019. And during the financial crisis, the credit card balances dropped too, but they dropped because these consumers defaulted on their credit cards, and banks wrote them off. And it took 4 years, and credit card balances plunged a whole bunch, but not because consumers paid them off, but because they defaulted and banks wrote them off. This time around, consumers are actually paying them off. The default rates are pretty low, and consumers have used the stimulus money and the extra unemployment benefits and the PPP loans that we have here in the United States. That's the payroll protection program that small companies, including individual owners, get to keep their payroll going. And a lot of times this is just one-man shops or with just one employee, namely the owner, and they got this money from the federal government during the pandemic. And so all this money that the federal government spent went to businesses and consumers, and some of this money was used to pay down credit cards, and that's amazing to see. We see that's close to $160 billion that the credit card balances have dropped since then, and so that's where that came from. Now, credit card debt is absolutely the most expensive debt on a large scale that consumers have, and the average credit card interest rate on balances that are actually being assessed in interest, so balances that are not being paid off every month, is 16% now, roughly. And compared to junk bond yields of double B rated junk bond yields of 3.3%. So we have this huge difference, a record difference between high risk corporate bonds and credit card debt, which is high risk consumer debt. And consumers are figuring out, we're really stupid to pay, 16 or in many cases it's more. It's 25%, sometimes 30% interest. And so they started paying this down, and that's a good thing. Any dollar in interest that a consumer spends on these credit cards, they cannot spend on other merchandise and services. So this credit card interest sends money from consumers to the banks and to investors. Whereas if consumers pay this off, they can save the interest and spend it instead on goods and services that merchants get. And so I think that's a good thing that they're doing that. Obviously, the Fed has really worried about that. They're really worried that consumers pay off this credit card debt because it represents a huge hit to earnings for banks. So they're making an average of 16%. On all this interest that we're talking about, roughly $20 billion in revenues per year for the banks that they're now lost. So the banks being represented by the Federal Reserve have already raised some commotion about that. Then the earnings announcements and so forth, they have been talking about this because it's a big loss of income for them. And so the banks are not happy about it, and the Fed's not happy about it. But in terms of the overall economy, I think this will be a good thing if consumers get off of this high interest credit card debt. And, if they stop borrowing from their credit cards, maybe lenders will finally cut the rates a little bit and come up with more reasonable offers. And that would be another good thing. And we might be able to see that. But, of course, when consumers start borrowing again, it goes back to normal. If it does, the banks will just raise the interest rates again. But in theory, now we have a lack of demand, and banks should respond by cutting the interest rates on their credit cards. And I think that would be a good thing. I think that would help the overall economy.
What's happening in the new and used automobile markets?
That is a once in a generation situation that I have never seen before. We now have a major supply issue, and so the way this is now showing up is that prices on the wholesale level so far this year for used vehicles have jumped by 20%, and they're up 40% wholesale prices since April 2019 for used vehicles, and the CPI, so our Consumer Price Index for used vehicles, prices have jumped by 10% in March just from April. That's a historic spike. I mean, it's never seen before. They're up. The CPI for used vehicles is up 20% since before the pandemic, and new vehicles are now in short supply, and people are paying over sticker to get them. I mean, so these are the things that we're looking at. What's happened beneath the surface is that last year, when travel shut down, rental car companies cut their orders, and they're ordering about 2 million vehicles, 2 million new vehicles a year from the automakers in the United States. And they slashed those orders, and they sold some of the other vehicles they had in the fleets in the auction market last year. And so then automakers also shut down some of the plants, and many of their plants due to the lockdowns and the COVID issues, and then even after they opened them, they had COVID issues, and they shut them down again. So we had the automakers cutting production last year based on these issues. And so suddenly the stimulus checks hit and demand explodes. So now we've got this supply chain getting wound down, and we've got exploding demand. And and the supplies can't ramp up fast enough. And in addition to that, we have several semiconductor plants that were shut down, some of them, a couple of them in Texas because of the cold, and one of them in Tokyo because of the fire, and there's some other issues. And there are semiconductors in practically every component of a car. And cars are just computers on wheels. They have semiconductors in absolutely everything: your door lock system, your window system, your dashboard. It's just a computer. So your gas pedal now is drive-by-wire, so that has everything has semiconductors in it. And so you only need to have one component with a semiconductor that can't be delivered to a plant, and the whole plant shuts down because you can't finish the car without that component. And that's been happening. So Ford announced, for example, that its production in the second quarter will be down, its global production will be down by 50%, so by half. Other companies have announced plant closings almost on a daily basis now, and it's happening everywhere. So there are now huge supply constraints on the market, and this is also impacting component makers. They're automakers just assembling the vehicles. The real problem is in the component manufacturing supply chain, where they can't get the semiconductors to build the components, and then the assembly plants are short those components and can't put those cars together. And so now we've got this booming demand stimulated by these $1 trillion stimulus packages, and it's facing the supply constraint from the auto industry. And this has completely distorted everything. So in terms of pricing, that's where it shows up. Prices have soared. There are hardly any deals now. So we're looking at a situation where consumers are facing much higher prices. They're facing very tight inventories. They're facing very short supply, especially on popular vehicles like trucks. And automakers have switched to producing only the most profitable vehicles, trying to switch production over to those. So the lower end is getting completely neglected, and lower end vehicles are just sort of falling by the wayside on the new vehicle market. People who want to buy a lower end vehicle have to go used, but there the prices are sky high too now. So this whole market is screwed up. Estimates were at first that it will that the semiconductor supply chain would sort of level off by the end of the year, and now the estimates are that it won't happen until 2022. So this will drag on, and there are now layoffs in some of the auto plants because they don't have the components to make the cars, so they lay off some people, and this is just a massively screwed up situation.
More and more automakers are building or planning to build electric vehicles. What do you see ahead for EVs?
Well, so today we got Ford introducing its new electric pickup truck. And the way it did that, it showed the new EV pickup, which looks a little different than the others. And it was lined up next to its other new pickup models. And that's how it's going to happen. You have a choice now going forward when you go to GM or to Ford or to any of the other dealers out there, and you'll be able to buy an EV pickup truck or a gasoline pickup truck, or and then there you have a choice between a hybrid and a regular gas vehicle, and you can also choose a diesel. So these are the choices now that will be available, and consumers get to choose, and they get to choose across the board because every automaker is doing this. And some of the brands will go to EV only for now. That's a minority. Most of them will have these parallel things, and EV models will be there in addition to their gasoline and diesel models. So consumers are the deciding entity, and for consumers, the equation is changing now. The EV electric vehicles are a lot cheaper to build. The battery is expensive, but the vehicle itself is incredibly simple compared to an internal combustion engine vehicle. The layout is beautiful. You have now the modern versions that are being built, not the Tesla, but the second generation that we're now looking at, that Ford and many of the others are putting together. They have generally two electric motors between the wheels, so one in the front, one in the back, and a battery pack below the floorboards, and then you can put anything on top of it. And that's the sort of the module that we're going to look at in the future here. And it is so simple compared to an ICE vehicle, and it is so cheap to build. And the battery technology is tough, but it's improving a lot, and the prices have come down a lot. And electric vehicles are so much more efficient because they have the regenerative braking, so you can generate electricity via your braking system and charge your battery that way. And we drive a hybrid, and that's how the hybrid battery gets charged. There's nothing else that charges the hybrid battery. It's just our brakes. And an EV does this much more efficiently, and electric motors are much more efficient than ICE motors, and so you'll look at a cost comparison from the consumer's point of view. What is cheaper for me? What is better? And if you've ever driven an EV, they're beautiful to drive. I mean, they're incredibly performing, and they're quiet, and there's essentially no vibrations, and they have enormous amount of torque. You don't have to rev the engine. You don't have to shift. You don't have to do any of these things. And so for consumers, this is going to be an interesting choice to have. Most consumers will buy an EV and charge it at home. So now we have cheaper electricity at night than we have during the daytime. That's starting in many places. It already has started. Utilities love the idea of EVs because electricity sales in the United States have been down for a decade. And so now finally there's some growth possibility for for utilities, and so they're loving this, and especially since EVs are being charged at night, most of them, when there is this huge idle capacity that utilities have to pay for but can't get revenues from, and EVs are going to solve some of that problem. EV charging stations in California are all over the place now. There's thousands of them. There's one down the block. They have 3 or 4 parking spaces where people park their cars. And then there are these pots that come out of the pavement, and you plug in your vehicle. And it's not like a gas station. There's no tank. There's no pumps. There's nothing. It's just a corner of a parking lot. And so I think consumers will have very attractive choices there, and in many parts of the world, EVs is the only growth business. In terms of automakers, that's the vehicle lines where sales are growing and the sales are declining in all the other vehicle lines. So automakers have seen that, and the decision will be made by consumers. That's where that will work, and it will take quite a while for consumers to completely switch. It will take decades probably, but or many years. But the move, the trend is there, and it's big, and that's I think where we'll be going. When you drive a pickup truck with 600 horsepower from 2 electric motors, with a flat torque curve, which is ideally suited for towing a trailer, or for performance driving, both. And it makes no noise. And, you won't go back to a gasoline powered truck, especially if it's cheaper to operate. And, that's the choice we're looking at. And I think consumers will vote with their pocketbook.
Is the significant inflation we're seeing today likely to be brought under control with much higher interest rates?
Well, if the Fed has the gumption to crack down on inflation, it can do that. And it has not only interest rates in its toolbox, it also has the $7 trillion in assets that it purchased in its toolbox. So if it really wanted to crack down on inflation and bring demand to a halt, which would bring inflation to a halt, it could announce that it would sell those assets and that it would then actually sell those assets. You'll see so much turmoil in the financial markets, and it wouldn't take much for demand to come down hard enough that inflation is just essentially history. The Fed never had this tool before. So now, in addition to being able to raise interest rates, it can sell the assets. And it doesn't have to raise interest rates very high now that it can sell the assets. So it could raise interest rates a few percentage points. It doesn't have to go to 15 or 18% like Volcker did back in the 80s, early 80s. It could raise interest rates just a little bit and start selling off its balance sheet. And that would have a similar effect in terms of slowing down demand, but it wouldn't create this enormous, these incredibly high interest rates. And so I think it has the tools to do that. I don't know that it is willing to do that because, the fallout in the financial markets would be extraordinary. And there'll be all kinds of fireworks if that happened. And, so we'll see, but that the Fed can do that, and I don't think it will do that if inflation is 4% or 5%. But if it threatens to go to double digits, well, nobody wants inflation to go, and especially at some point, inflation can really get out of hand, and then it's very difficult to deal with. At that point, the Fed could actually start thinking about selling off its balance sheet to bring inflation down, and I'm pretty sure that would work very quickly.
Do you think gold and silver are likely to get moving with all of the inflation we're seeing?
Well, silver had a very good year last year, and gold has had a very good year since 2018. So they both have come up a lot, and by about 50% over those periods, and or more, and that's a lot. That's a big move. And so I'm not convinced that they would have to go higher. You're looking at inflation of 4, 5, or 6%. How much does gold have to rise? Does silver have to rise to compensate for that? And what would be the value of hedging against that type of inflation? Would you be willing to pay 50% more for gold to get there? And I think there's some learniness about that. Because gold can also go down. These cryptocurrencies were bought as a hedge against inflation, and they have crashed now. So you're trying to hedge against 4% inflation. You buy an asset that then crashes 50% or 40% or 30%. So there's a huge risk in trying to hedge against inflation. And I think looking at how silver and gold moved over the last couple of years, I think some of that has already been done. People have already bought it in anticipation, and I have trouble seeing that this will go much further, and it could. I'm not saying it can't, but I wouldn't expect it.
As the COVID restrictions are lifted, what are the markets likely to do?
So we've had trillions of dollars in stimulus that went to consumers and to businesses, and much of that has been spent. And so when you look at especially consumer spending, it spiked by 21% in March from February. That's a huge historic spike because consumers got the stimulus checks and they went on and spent them. And consumer spending has boomed during the pandemic because of the stimulus spending. And so now the stimulus is over. The stimulus checks are petering out. The extra unemployment benefit will end in September. In some states, it's already ending sooner. The PPP loans are fading out. And so, that stimulus is essentially gone or will be gone by later this year. And so, that power under the economy is fading. And what we have left is sort of the normal thing, people trying to make money and spend the money, and that will be on a lot lower level. Markets have boomed already based on the stimulus. Now the stimulus is gone. So, all this has been front-loaded. A lot of spending has been front-loaded. There will be a big shift in spending from goods to services. So consumers couldn't go on overseas vacations, and they couldn't, get on cruises, and they a lot of times restaurants were closed, and theaters were closed, and hairstylists and gyms were closed, and so they didn't spend money on these so-called discretionary services, but they spent them on goods, and now they can spend this money on those discretionary services, and they will, and they do. And so they lower the spending on goods and they increase the spending on services, and we're already seeing the first parts of that, and consumer spending overall will come down pretty hard because the stimulus is fading, and it will shift from goods to services. So services will come out ahead. Goods, meaning retail sales, will come down, and the stocks that have risen with the stimulus that went to consumers are now going lower. There's other stocks that may be going up, and so I think overall the stimulus has driven the market. Central banks have driven the markets. Now that's coming off, and what's left is sort of the regular economy, and I don't. The opening of the economy will be, I think, a net negative for the stock market because it will entail a reduction in central bank support, and it will entail an end of stimulus payments.
Wolf, is there anything else that we should be keeping a close eye on right now when it comes to the economy and financials?
Well, I keep a close eye on my website, that's for sure, wolfstreet.com. But on a more serious note, the interest rate environment and central bank support has driven all of this, and so long-term interest rates will have a huge impact going forward, and that's what definitely I would keep my eyes on.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim, for having me.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Robert Campbell, and Wolf Richter. And thank you for listening. If you have any questions for the show, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
Larry, you had a news release this week. What was in it?
Well, it was discussing, if you remember back 10 months ago, we announced that we were going to look into doing a spin-out of our mining assets in British Columbia. And so the reality is that after a lot of investigation, it looks like there's no advantage for the shareholders or anyone else to spin it off into a separate company. And the reason I say that is that according to the regulations on the TSX Venture Exchange, if we put $1 million over to the new company, that will allow us to give a half a share for every 10 shares held. And if we put $2 million over, that would allow us to give us 1 share for every 10 shares held. So that doesn't look like a great deal for American Manganese, because that would suck down our treasury. And so it's not what we would want to do. We were hoping that we'd be able to do some kind of like an IPO that would put money into that company. But it was a different time, a different place. 10 months ago, the price of the company was 25 cents, and we didn't want to face a lot of dilution to get working on our mining properties. So it looked like the solution was to spin them out into a separate company. But now that doesn't work on a benefit for shareholder basis, and so we've decided to cancel that. In the meantime, the company has proceeded with a 43-101 report, which has been filed. We've done deals with the native groups. We have moved the property ahead in other various ways. We've had application in with the mines department out of Smithers to drill the property this year, and it looks like we're in line to get that happening. And one of the key things was to settle out with the native groups, and there's a lot of pushback on that, but the reality was we came to an agreement, and I think that will be announced at a further date, but it looks like we can proceed with the application. That's what the government was waiting for. And we could be up there this, probably early this summer, because there's a lot of snow up in the hills there yet. Last time I checked, which was earlier this week, there was still a lot of snow up on the hills. Nothing was melting. And, you can get up to 10 or 12 feet up there, so we have to wait till the snow goes, and hopefully we should be in there as early as July and get our drill program going. So I think the benefits for the shareholders leaving it in AMY are much more appealing than the benefits for spinning it out, because I'll give you an example. Let's say we put $2 million over, and you get 1 share for every 10. So if you had 10,000 shares, now you got 1,000.
and you made a significant discovery, the stock might go to, let's say, $3 or $4. But in reality, if it was still in AMY, the stock could go up $1.50, and you'd have 10 times the amount of shares issued. So it's just a matter of math to figure out where do you benefit. And so it was a pet project of mine that I pushed along, and but the reality was, at the end of the day, it just didn't make sense for the company, and certainly did not make sense for the shareholders. So we moved on to keeping it in the company, and there's always an opportunity to flow through shares to do the work up there. I've already got people inquiring about that, and we could get enough flow through done to do this summer's work. And so that's kind of where it sits. I'm anxious to get on that property. I have been anxious for quite a few years. We got involved in Manganese, and we ignored the benefits of the Rocher de Boule property, where there was a past producer on it that ran up to 6% copper. And if you're looking for a deposit, if you're looking for a new deposit, the best place to start looking is where there was a mine. And so there was a mine on this property, so I got high hopes for it. But you have to remember now, that's high hopes. But, if we're lucky, we should hit this summer. It might be next summer, but, it's something that has to be done. I mean, there's all kinds of mineralization on that property, including cobalt and nickel, gold, and zinc and lead and molybdenum, and you name it, it's there. And so, it's either an iron oxide copper gold, or it could be a big porphyry. And either way, I'd be happy to hit it. So that's kind of the story on what's happened to the spinout. I know that a lot of people were interested in the spinout. Some of them held on to their stocks so they get involved in the spinout, but that also allowed them to get involved in the last run-up in the shares. So it's not like it was a loss. So here we are. The stock actually moved up on that release today to $1.03, and but with the predator trading, at the end of every day we end up down, and so we ended up at 93 again. So it's these guys have got to be stopped, and it's up to the shareholders to to start complaining to the regulators about this rule and how it's harming the whole industry. I mean, I know one company out there that's got 27 million ounces drill, measured, and indicated, and inferred, and we announced that, and the stock went down, and it's below $3 today. So, and they can't seem to get going. It's terrible. I mean, if back when I could think about it, if that was one of the biggest deposits that I'm aware of, especially in British Columbia, and it should have, in my opinion, should have been several dollars higher, but it's not, and so that's kind of where we're at right now. And we've beaten them twice, and I'm looking forward to the third time. So they have all the advantages are on the side of the shorters. There's no advantage to the investors. The investors just keep losing money. But it does set up a scenario where you can buy stock cheap. Our project has moved significantly along, and we'll probably be doing our mine, not mine, but our plant design and estimations within a couple of months, and that'll put us on steady footing, and then we can start to project times, everything else. Until we get there, I wouldn't project times. I don't like projecting times because it's also a blueprint for predators, And so they can line up to, as they do now, to kill every press release that goes out. And, that's not fair. It's not fair to the shareholders. It's not fair to investors. It's not fair to anybody but the predators. And they make all the money and run home with your profits. And so let's just look at this as an opportunity to give us another cog in the wheel. And, I think the recycling is definitely where the action all is. But there's also action happening on the work that we're doing for the DLA. And that action is, the strategic stockpiles in the U.S. It's being funded by the DLA. And that work is ongoing, and which could result in another look or a joint venture on our holdings in the Artillery Peak area that could be turned into a mining operation. Don't forget, we have patents on that too. So, it was for all opinions, it was a good day. I know people are impatient. Companies are doing deals with absolutely nothing around them. I mean, they're not saying how they're going to do the things they claim they're going to do. And but when we say, "Hey, we can do that," we'll know that answer within a few weeks. So it's all in the morphology now, which has slowed us down considerably and cost us a lot of money. But if that's what the end market wants, that's what we want to deliver. So let's just keep on trucking, and away we go. So I didn't have any questions to answer today. I didn't submit any that I'd received, because I figured that a discussion on the spinout and the fact that we've dropped the spinout was foremost.
Larry, for people new to American Manganese, what's the company all about?
American Manganese is a critical metals company that has developed a process for treating low grades of manganese in the U.S., and that's a patented process. And from that patented process, which is now the cornerstone of our recycling, is what's moved the company into a new era. And I couldn't be happier. I'm not happy with the prices it is right now, but I can see a lot of things happening. A lot of people don't realize that there is a lot happening within the company. And, we've talked to a lot of the big players out there. So, we've turned down some offers that were just would have been company killers as far as I'm concerned. But, that's our process, and you can find all the information. We're very transparent about all our results, so you can find it on our website at AmericanManganeseInc.com. We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the QB Exchange under the symbol AMYZF, and we're traded in Frankfurt under the symbol 2AM. And you can reach the company by emailing me at LREAUGH@AMYMN.com, or you can phone the company at 778-574-4444 and get all the information that you want.
Larry, thank you so much for the update.
Thank you.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on May 21st.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.